You probably know this feeling when your trade goes in the wrong direction and
Baby, you got something in your nose.
you see your loss just getting bigger and bigger. I had a similar experience, and after such situations I became interested in hedging. What is hedging, you may ask then? Well, hedging is a technique that can literally reduce the money loss of unsuccessful trades to zero, or if you do it right, you can even unsuccessful trades make successful. And yes, I mean literal profit from unsuccessful trades, even if that doesn't make any sense in your head. I also will compare our lovely stop loss with the hedging technique and show you why hedging is just better. Why I don't use the stop loss? Well, I do, but not every time I open a trading view. I use stop loss as a protection against sudden market crash or sudden price spike. I place it far away from the current price in a place where I'm sure the price will go in the opposite direction to the previous move. So there's need to be some larger distance and some larger timeline, you know? In the case of the cryptocurrency market, I only set it closer to the price when I go to sleep and I cannot actively monitor the market. On daily basis I set alerts for the latest high and low, and in the meantime I can do just something else. This way I can control the risk of the position without having to stare at the monitor all the time. I usually close the position manually at the loss because I often wait for the price to recover after breakout in the wrong direction. This allows me to minimize the losses. Hedging involves opening opposite positions to minimize the risk of the losses. When the price moves in an unfavorable direction, we open an additional position in the opposite trend, which allows us to reduce potential losses or even end with a profit, even if the original trade turns out to be unsuccessful. Personally, I add to this adding another position even when the price goes in the wrong direction, but I believe it will turn around, so if it does, I often exit without any loss, like at all, at the end. So, you know. Now, why hedging is better than the stop loss? Well, hedging gives you more freedom and flexibility in risk management. When we use a stop loss, sometimes it happens that the price only slightly touches our level and then turns in the opposite direction that we expected. Hedging eliminates that risk. Even if the price temporarily breaks out by opening an opposite position, we give ourselves the opportunity to react. We can close this position with a minimal loss or keep it and try to exit it without a loss at all. This allows for dynamic adaptation to changing market conditions, which is crucial in trading where each situation is different and a lot depends on the context. Hedging allows for creative risk management. Thanks to this technique, we have a lot of freedom in risk management, thanks to which we are able to adapt to various market conditions, which is especially important in trading when there is no one universal strategy for making money. The ability to hold reverse positions and flexibly close them with minimal losses or profits provides a significant advantage and allows you to manage your portfolio effectively. And finally, practice. We will take Litecoin this time. And maybe let it be April, somewhere in the middle. Well, I classically start by determining support and resistance. And I'm going short because we are in the resistance zone. And unfortunately it worked out, so I'll wait for another opportunity. Same situation again, resistance and short again. Okay, the price has gone in the wrong direction. I'll wait because it may go a little lower. And the price immediately went up, so I'll bet this long. And yet it doesn't make much sense because from what I see we are just below the potential resistance zone, so I will give up this long. I see that the price has clearly gone down, so I place a second short. Now I will set myself a price at which I will compensate for the loss and let go of time. This horizontal line will mark this zone for me, of course. The price dropped, so I closed the initially losing position without a loss. Additionally, I will bet this long because we are on support. This time it worked. I will speed up the time until the price goes in the wrong direction again, just like you see on the screen. Finally failed to trade. The price is slowly rebounding from the support, so I do what I did before. I add it to the position and set the price at which I will exit without a loss. I managed to turn a losing trade into an exit without a loss again. Losing trade again. This time I will add long because the price has definitely risen and I think it will go up. I see that it was not possible to break a new top after 3 attempts, so I have the impression that it will fall below the support, but for the sake of demonstration I will just leave this long position. The price actually dropped as soon as it touches support. I will close the short and add to the long. And like I said, I closed the short and add a long. And it managed to get out of the long without a loss, ending with a profit from a supposedly losing position at the beginning. That was quite long practice. Hedging is a good solution for flexible risk management. Thanks to the freedom it gives us in making decisions, we gain greater control over our transactions, avoiding typical traps that are really easy to fall into. Of course, like everything else, hedging cannot be mastered right away, so test using it on demo account and maybe you will use it better than using stop loss. A lot depends on your own trading style. For me, hedging works much better than the stop loss, but it doesn't mean I never use it. Sometimes it is more profitable for me to set a stop loss. In trading, a lot depends on the context, so it is best to simply practice and draw conclusions from the mistakes you make, really. Bye.